Welcome to This Explainer. All right, we are zeroing in on a genuinely explosive week, July 19th to the 25th, 2026. In just those 7 days, a massive $4 billion of capital moved across just 5 insurance deals. Let's dive right in, because what happened that week gives us a crystal clear map of where global capital is concentrating and, honestly, the structural gaps it's leaving behind. $4 billion. I mean, that is a staggering amount of money to see deployed in exactly 1 week. But we're not just going to sit here and look at all those zeros. We need to decode the logic behind these moves, because that's going to reveal exactly where the future of risk and distribution is headed. The really fascinating part? This capital didn't flow evenly at all. It completely polarized. If you look at these 5 deals, they form this perfect barbell strategy. On one end of the barbell, you've got global giants dropping billions, literally billions, to buy legacy distribution. Then, on the exact opposite end, you've got these agile startups securing single-digit millions in seed capital to fix the structural gaps those same giants are completely ignoring. And right there in the middle, one highly disciplined, incredibly focused acquisition. Let's start with the heavyweights. Act 1, the billions. This is all about buying time and access. Okay, consider this 44% premium. Mapfre, Spain's largest insurer, paid $1.54 billion in cash for Safety Insurance Group. That is a massive 44% premium over its trading price. And get this, they did this despite Safety suffering a brutal first quarter. We're talking consecutive winter storms producing $42.7 million in property claims, which pushed their combined ratio up to 113.4%. AM Best was actively revising its outlook, and insiders were selling. So you gotta ask yourself, why on earth pay a 44% premium for a company with a bleeding combined ratio? Well, it's because Mapfre isn't buying the trailing quarter. Not at all. They are using their rock-solid balance sheet, backed by a €624 million first-half net profit and a very healthy 92.8% combined ratio, to buy a Massachusetts franchise that's been around since 1979. They're buying an established brand and these deep, irreplaceable independent agent relationships all across New England. You just can't quickly replicate 40 years of local trust. Mapfre is basically paying a premium to skip the timeline. Let's move to our next massive deal and see how this theme builds. Allianz dropped roughly €2 billion for HSBC's Singapore life insurance unit. But pay attention to how this was actually priced, because we see a stark separation of assets here. They paid 2.7 billion Singapore dollars for the carrier itself, which is a platform with 80 million euros in operating profit. But they paid a separate, very explicit 200 million Singapore dollars strictly for 15 years of exclusive bancassurance access. This brilliantly illustrates our core theme for today. In Asia's affluent markets, who you can reach matters just as much as what you sell. Allianz paying $200 million for the channel alone proves that for sure. As CEO Oliver Bate noted, this move solidifies their APAC headquarters. But there is a super vital backstory here. Remember back in 2024, Allianz tried to buy a stake in income insurance, but it totally collapsed because of the target's social mission obligations. This HSBC deal succeeds politically precisely because it lacks those social strings. It's just clean, exclusive access to premium wealth management clients. Act 2, the disciplined middle. Right in the middle of our barbell, we have Horace Mann's $240 million acquisition of 2 Medical Mutual of Ohio businesses. CEO Marita Zaritis really grounds this deal in a strict capital allocation strategy. They paid a highly disciplined 10x net income for Reserve National Insurance Company. It's a move that makes the deal immediately accretive to their core earnings per share. So no wild premiums here, just exact, strategic execution. But look at what that $240 million actually gets them. They are adding nearly $200 million in annual revenue, bringing 1 million covered lives onto their platform, and adding 7,000 employer relationships. What's absolutely genius here, though, is the addition of an employee assistance program, which brings in a behavioral health support layer. Horace Mann's entire competitive moat is being the sole focus provider for K-12 school districts and educators. Now, they can offer the complete suite of benefits to a teachers' union from a single source. Talk about locking in your customer base. Act 3, the seed round. This is all about fixing the gaps. Who pays if this breaks something? That single question is the massive procurement blocker stalling 80% of Fortune 500 companies from fully deploying autonomous AI agents today. The agents are ready to buy, send emails, and modify data, but enterprise legal teams are slamming on the brakes. Why? Because nobody knows who holds the bag when the AI hallucinates a contract or leaks data. And the reason nobody knows who pays is actually pretty simple. Giant carriers like Berkshire, Chubb, and Travelers are actively running away from this risk. They're pushing ISO endorsements, like CG 4047, to explicitly exclude autonomous AI agent failures from standard U.S. commercial policies. And this is all happening right as the EU AI Act enforces strict liability on AI deployers starting in August 2026. AI lawsuits are already up 137% year over year, yet enterprises are completely naked in terms of coverage. Well, enter Klaimee, backed by $5.5 million in seed funding from heavyweights like Y Combinator and Funders Club CEO Ines Bouchardjiu, who, by the way, already built a $60 million safety wing MGA, is stepping up to solve this. Klaimee executes 4 exact steps. They audit the agent, certify the risk, provide purpose-built AI liability coverage, and generate the documentation that those enterprise legal teams desperately need. They aren't just building a marketplace for old policies, they are literally building the answer to unblock enterprise AI procurement. Moving to our final deal, let's look at Coverwatch's $4.5 million pre-seed round. This beautifully contrasts a massive structural conflict of interest in the insurance industry. See, legacy brokers earn a commission tied to premium size. In a market with $400 billion in premiums, brokers take home $40 billion. The structural conflict is staring us right in the face. Brokers earn more when you pay more. Coverwatch is building an aligned, flat-fee II alternative to tear this entire model down.
And their traction is incredibly telling. Coverwatch's tiny 6-person team is already licensed in 17 states. Their platform uses an AI extraction pipeline to evaluate complex risk and solicit bids from over 50 carriers. They are specifically targeting complex profiles that traditional commission-based brokers tend to underserve. Think homeowners associations, venture-backed tech, and e-commerce brands. Because their incentives are completely aligned with the client getting the lowest possible price, their revenue has literally been doubling monthly since Q2 2026.
That brings us to our final section, winners and losers. Value in a maturing market is created at the absolute edges. You're a winner if you have the massive capital to buy existing legacy distribution, like Mapfre and Allianz. Or you're a winner if you have the agility to cover the exact risks and structural conflicts the giants are ignoring, like Klaimee and Coverwatch. But if you're a regional carrier facing Mapfre's new footprint, an uninsured enterprise deploying AI, or a legacy broker relying on those conflicted commissions, well, you are structurally exposed. As we wrap up this explainer, I really want to leave you with a crucial thought. We just watched incumbents spend billions to buy the past, while startups raised millions to underwrite the future. With traditional markets consolidating and entirely new asset classes like AI agents completely unserved by the giants, you have to ask yourself, where exactly will the market's next $1 billion be forced to flow? Thanks for joining me, and keep your eyes on the edges of the market.